Imagine a custom modular kitchen being installed in a luxury Mumbai penthouse.
Right, something really high-end.
Exactly, like a 20 lakh rupee setup.
Yeah.
The imported wood veneers are flawless.
hmm
The brass hardware is perfectly aligned.
It looks like it belongs in an architectural magazine.
Yeah, it really does. But if the contractor slaps on the wrong chemical finish just to save a few thousand rupees,
Mm.
well, within 6 months, Mumbai's humidity will completely warp it.
Oh, yeah. The morning sun will yellow it, too.
Right. And the first time someone spills hot coffee, it just leaves a permanent cloudy ring. That 20 lakh rupee investment is completely ruined. And it's all because of a micron-thin layer of paint.
It's the ultimate hidden point of failure, you know? The consumer touches the finish. They don't actually touch the wood.
Yeah, that makes sense.
They interact with the chemical resistance, the scratch barrier, the exact depth of the gloss. If that fails, I mean, the entire piece of furniture fails.
And today, we are zooming in on the company that charges a premium to ensure that failure never happens.
A very significant premium.
Definitely. We're putting our lens on an under-the-radar challenger in the highly specialized wood coatings market. Sirca Paints India Limited, or just Sirca.
Which is such a fascinating case study.
It really is. We have a stack of research notes, market estimates, and company disclosures here to help you understand this. Okay, let's unpack this. Sirca isn't trying to sell a bucket of living room wall paint to every homeowner in the country.
No, not at all.
They want to be the unquestioned gold standard for a very specific, highly lucrative customer. So our mission today in this deep dive is to figure out how they've carved out this incredibly profitable niche in Italian polyurethane finishes.
Right, and whether they can actually defend that turf against the giant paint monopolies.
Exactly. Because they have this stated management target to reach 1,000 crore rupees in revenue by 2030.
Which is a bold target, to say the least.
But before we get into the financial mechanics or, the 2030 roadmap, I want to spend a minute on the chemistry and the canvas itself.
The playground they operate in, basically.
Yeah. Because when I first looked at the sources, I thought, well, wood coating, so it's just varnish.
Right, that's what most people think.
But Sirca's product map is wild. They sell premium polyurethane, PU finishes polyester, acrylic, UV products, and these incredibly complex special effects.
It is light years beyond a simple can of varnish, I mean, truly.
Sounds like it.
To understand Sirca's pricing power, you really have to understand the technical gap between traditional finishes and what Sirca actually sells.
Okay, lay that out for us.
So historically, a lot of Indian furniture was finished with basic nitrocellulose, or NC lacquers, and cheap melamine.
Which I'm guessing is not great.
Well, they are functional, but they're very brittle. And melamine notoriously yellows when exposed to UV light.
Oh, so that's why old cabinets get that weird, sickly yellow tint after a few years near a window?
Exactly. The polymer chains literally break down. But when you step up to high-quality polyurethane, which is, Sirca's bread and butter, you are dealing with cross-linking polymers.
Cross-linking polymers.
Yeah, they create this flexible, incredibly dense, chemical-resistant shell. It flexes with the wood as the temperature changes, so it doesn't crack.
Oh, wow.
And it repels heat and moisture. It's an engineered protective system, not just a decorative stain.
I see. It's the difference between throwing a cheap plastic poncho over yourself in a hurricane versus wearing a tailored, high-tech Gore-Tex suit.
That's a very apt way to look at it, actually.
Both technically repel water, but only one is surviving the storm without ripping.
Yeah, exactly. And because it's a high-tech system, Sirca doesn't just sell one can.
What do you mean?
They sell the specific stains, the specialized sealers, the exact thinners required to make the PU cure correctly, and then the final top coats.
So it's a whole package.
It's an entire ecosystem of chemicals designed to interact perfectly with each other.
Which brings us to the actual size of this market. If we look at the total addressable market in India, the broad wood coating space is estimated somewhere between 7,500 to 10,000 crore rupees.
Yeah, and Sirca's management specifically pegs it at 9,500 crore.
But if they're only selling the Gore-Tex of wood finishes, they aren't actually playing in that full 9,500 crore arena, are they?
No, not at all. And breaking down that market sizing is really crucial for understanding their runway.
Right.
That broader 9,500 crore figure, it includes all the low-end commoditized stuff we just talked about. The basic NC, the cheap melamine, the standard turpentine thinners.
So the cheap ponchos.
Exactly. Sirca's primary battleground is exclusively the premium and high-quality PU subsegment.
And according to the notes here, that specific premium niche is only about 3,500 to 4,000 crore rupees.
Correct. Now look at their market penetration. Across the entire broad 9,500 core market, Sirca only holds about a 4.5% share.
So they are a tiny blip on the radar compared to the overall paint industry volume.
They are. But when you isolate their performance to their core 4,000 crore premium PU niche, they suddenly command a 15% market share.
Okay, wow. A 15% share makes them a heavyweight in the premium tier.
Absolutely.
But I'm looking at that 85% of the premium market they don't own. Who is sitting on the rest of it? I mean, is it just completely fragmented?
What's fascinating here is that the fragmentation isn't just about competing brands. It's about the fundamental way wood finishing is executed in India.
How so?
It's largely unorganized. Think about the traditional interior fit-out for a middle to upper class Indian apartment.
Okay.
You hired a local contractor, and they bring in an on-site carpenter. That carpenter sets up shop in your living room, cuts the MDF or plywood, and then hand mixes unbranded or locally tinted finishes right there on the floor.
Oh, man. Breathing in fumes, guessing the mixing ratios, using whatever cheap melamine the hardware store had on discount.
Exactly. It is highly informal. The quality control is totally non-existent. So Sirca's real growth engine isn't just about battling another premium brand for a few percentage points of market share. Their growth relies on driving a structural shift.
Shift away from that on-site mixing.
Right. They need to convince the market, specifically the contractors and the newly wealthy consumers, to abandon that unbranded, on-site, locally mixed approach and upgrade to standardized premium PU systems.
So it's an education problem as much as a distribution problem, really.
Very much so.
But surely paint is paint to the average consumer. Like, if I'm buying a dining table, I just want it to look nice. How does Sirca convince someone to pay a premium for their specific cans of liquid?
Well, that gets into their whole brand identity.
Because the sources lean heavily on this Italian technology angle. Sirca India has an exclusive, irrevocable license with the Italian brand Sirca SPA, valid all the way until 2041.
It is the absolute cornerstone of their brand identity. The Indian company localized the production and distribution, sure, but the brand prestige is imported straight from Italy.
I have to push back on this, though.
Okay, go ahead.
Is Italian heritage a genuine, defensible technological moat? Or are we just talking about clever marketing here? I mean, chemistry is chemistry, right?
I see where you're going with this.
A polymer chain doesn't care if it's synthesized in Milan or Mumbai. Can't a massive chemical conglomerate just reverse engineer the high-gloss PU and sell it for 20% less? Why does the Italian flag on the fort can't actually matter so much?
It's a really critical question. If you look at this purely through the lens of molecular chemistry, it is only a partial moat.
Right.
You are absolutely right. The chemical formula for a high-gloss PU finish is not some mystical secret locked in a vault in Rome.
Huh.
Other top-tier chemical engineers can absolutely formulate high-performing wood coatings.
Okay, so it's not a patent monopoly protecting them.
No, it's not. But you are discounting the psychology of the B2B buyer and really the concept of signaling risk.
Signaling risk.
Yeah. In the luxury tier, Sirca's long-standing specialist reputation acts as a formidable barrier. Let's look at who actually makes the purchasing decisions here. It's rarely the homeowner. The buyer chain is deeply layered.
Yeah, let's unpack that ecosystem because the sources detail a very specific, very sticky B2B2C model.
Exactly. At the base level, you have the distributors and dealers who actually stock the inventory, and they're buying on credit.
Right.
Above them, you have the OEMs, the original equipment manufacturers. These are the highly organized factories churning out the luxury modular kitchens and custom wardrobes you see in high-end showrooms.
But the real power brokers seem to be the architects and the interior specifiers, the people drawing the actual blueprints.
Precisely. The architects don't buy the paint. They don't cut the check to Sirca, but they write the specifications.
Yeah.
If an architect specifies, Sirca Italian PU finish, shade code 402, and the project blueprint for a luxury hotel lobby, the contractor is contractually obligated to procure it.
Because the architect is putting their own reputation on the line.
Exactly. If the finish flakes off in 2 years, the client blames the architect, not the paint manufacturer.
Oh, so the Italian branding is a de-risking mechanism for the architect. They specify Sirca because the heritage implies a guarantee of aesthetics and longevity.
You hit the nail on the head.
They aren't going to risk a 50 crore rupee hotel project on a newly launched, unproven domestic paint brand just to save the contractor a few thousand rupees on materials.
Exactly. It's a spec-in advantage, and once a brand is spec'd in, the switching costs become really substantial.
Now, I understand software switching costs, migrating databases is a nightmare. But how hard is it really to switch a liquid coating?
It's harder than you'd think.
Like if a competitor walks into that modular kitchen factory and offers a 20% discount on their PU, why wouldn't the factory just pour the cheaper stuff into their spray guns?
Because the workflow of a modern high-end furniture factory is calibrated to the micro level.
Really, to that extent.
Oh, yeah. When an OEM adopts the Sirca finishing system, they spend weeks tuning their environment to it. They learn exactly how the Sirca thinner reacts to the ambient humidity in their specific factory.
Yeah, okay.
They calibrate the drying times on their racks. Their applicators develop muscle memory for the exact viscosity of the Sirca top coat.
So changing the paint means changing the entire manufacturing rhythm.
Exactly. If you switch to a cheaper competitor, you have to halt production, retest the new chemical reactions, retrain your floor staff on application techniques, and most importantly, you risk a drop in the final visual quality.
Which will ruin the product.
The financial risk of ruining a batch of luxury cabinets far outweighs the marginal per-liter savings on the coating. This creates a moderate but incredibly lucrative lock-in. Sirca gets deeply embedded in the ecosystem.
It's a brilliant wedge strategy, really. But the sources also show Sirca isn't just staying in the luxury penthouse.
No, they're moving.
They are pushing down market, expanding their product map aggressively. We've got Sirca PU as the premium core, but now they have Unico for mass market wood coatings.
Right.
They have Oikos for texture coatings, there's Welcome for thinners, and Wembley, which covers enamels, standard wall paints, and sanding sealers.
The portfolio expansion is a classic lever for driving volume through an existing distribution network.
But doesn't this introduce a brand dilution risk?
How do you mean?
If you spend decades building an aura of exclusive imported Italian luxury, and then I see the same company's logo on a cheap bucket of standard wall enamel at the local hardware store, doesn't that shatter the illusion?
Well, it's the tightrope every premium brand walks. Look at the auto industry. How does Porsche sell a mass-market SUV without ruining the prestige of the 911?
Fair point.
Sirca is managing this through distinct brand architectures. Notice they aren't calling the cheap wall paint Sirca standard.
Right, they use the Wembley brand. They use Unico.
Precisely. So it's a house of brands, not a branded house.
Ah, I see the distinction.
It allows them to capture broader dealer shelf space. A dealer might not have enough premium clientele to only stock luxury Italian PU, but if Sirca can also supply their fast-moving thinners and mass-market enamels under the Welcome and Wembley labels, the dealer relies on Sirca as a comprehensive vendor.
So the mass market products act as a Trojan horse.
Exactly. A Trojan horse to secure the distribution relationship, while the core Sirca Italian PU remains insulated at the top of the prestige pyramid.
That makes total sense. They are expanding their footprint, but they are swimming into deeper waters. And the apex predators of the Indian paint market are absolutely noticing this highly profitable premium niche.
Oh, they definitely are.
The competitive landscape here is a classic David versus Goliath setup.
And the Goliaths in this industry have unmatched financial and logistical firepower.
Let's categorize the threats based on the research. First, Sirca has its direct specialist rivals. Pitilite operates the ICA brand, which the sources highlight as Sirca's closest direct competitor in the premium space.
Right, they're a very strong competitor.
Then you have global heavyweights like Malisi, Renner, and AkzoNobel's Sikkens brand, all fighting for that same architect-specified European finish prestige.
Those are peer-level threats. They fight on the exact same terms Sirca does. Heritage, technical specs, and application quality. It's a fair fight.
But then you look at the Goliaths. Asian paints, burger paints, Kansai Nerolac. Now, according to the numbers, Sirca actually holds its own in its home territory.
Yes, in the north.
Right, in North India and the Delhi NCR region, they claim a market share ranging from 28% to an astonishing 45% in the premium tier.
Which is phenomenal.
But they are a regional powerhouse, not a national behemoth. If Asian Paints decides they want that 45% share in Delhi, how does Sirca possibly defend against a monopoly that has a tinting machine in literally every zip code?
Well, if we connect this to the bigger picture, you have to differentiate what wins business in decorative paint versus what wins in industrial or premium wood coatings.
Okay, what's the difference?
In mass decorative paint, it's a game of sheer distribution, ubiquity, and pricing power. Asian Paints wins because they can restock a rural hardware store multiple times a day.
Right, because if I'm painting my guest room, I just want a nice shade of blue. I want it cheap and available right now. I don't need a chemical engineer to help me use a roller.
Exactly. But in premium wood coatings, the basis of competition completely inverts. Ubiquitous distribution is less important than technical service, flawless performance, and an expansive shade range.
Because of the failure risk we talked about earlier.
Correct. The Goliaths try to push their wood coating SKUs through their massive existing decorative dealer networks. But Sirca counters that brute force with a high-touch specialized model.
High touch in what way?
They have built these Sirca Studios high-end experience centers where architects can actually see the finishes. And more importantly, Sirca employs specialized technical applicators.
So they aren't just selling the paint and walking away.
No, they don't just ship a can of paint to a dealer and hope for the best. Their technicians go to the modular kitchen factories, they go to the job sites, and they physically train the carpenters on how to apply the product perfectly.
It's an embedded services model. The giants want to push cardboard boxes, but Sirca wants to guarantee the final aesthetic outcome.
And that high-touch execution is what secures the spec and stickiness we mentioned. An architect trusts Sirca because they know a Sirca technician will ensure the contractor doesn't mess it up.
Right, that makes total sense.
The strategic question is whether Sirca can afford to maintain that labor-intensive, high-touch model as they expand nationally against competitors with infinitely deeper pockets.
Well, to answer that, we have to open the ledger and look at the scoreboard, because their financial health dictates how long they can fight this ground war.
Absolutely.
And looking at these metrics, the unit economics are frankly incredible.
They operate from a position of profound balance sheet strength.
Let's just state the facts from the sources. We are looking at a net cash company. Total debt is sitting at a mere 45.2 crore rupees, completely offset by cash and short-term investments of 110 crore rupees.
Very healthy.
And their interest coverage ratio is a staggering 113.9 times.
Which means their operating earnings could cover their interest obligations over 100 times over. Debt servicing pressure is practically non-existent.
But it's not a flawless machine. The friction point jumps right off the page when you look at the working capital cycle.
Yeah, that's the tough part.
Historically, it stretches anywhere from 150 to 209 days.
Which is very long.
It's like they have this bulletproof, overflowing vault of cash, but the plumbing bringing the cash in from the market is clogged with concrete. Why does it take half a year for a rupee to make its way back to their bank account?
It's an inherent flaw in their current supply chain and channel strategy. Remember, a significant portion of their core highest margin PU is imported straight from Italy as finished goods.
Okay.
That introduces agonizingly long shipping lead times. You have to navigate customs clearance. And to ensure they never stock out when an architect specifies their product, they have to hold sizable buffer inventory in their domestic warehouses.
So cash is just sitting in drums on ships and in warehouses.
Yeah. Yes. And on the other end of the cycle, they are fighting the Goliaths for dealer loyalty.
How does that affect the cash?
To convince a dealer to stock Sirca instead of an Asian Paints premium SKU, Sirca has to offer highly favorable extended credit terms to the trade. So their cash is tied up before it gets to the dealer, and it's tied up after the dealer takes possession.
It's a squeeze on both ends. But when that cash finally clears the cycle, the margins are beautiful. Let's talk profitability.
Sure.
The premium imported PU carries the highest gross margin in their entire portfolio. But obviously, because it's imported, they are totally exposed to freight costs and the euro exchange rate.
Which is exactly why their push for domestic manufacturing is so vital. Local production carries a slightly lower gross margin profile compared to the ultra-premium Italian imports, but it radically shrinks that 200-day working capital cycle.
And the blended result of this strategy is compounding incredibly well.
Let's look at the recent quarters.
Okay, let's look at the numbers. Q4 FY26 sales hit 134.29 crore rupees, delivering an EBITDA margin of around 20.1%.
Very strong.
But the real story is in the Q2 FY26 numbers. Revenue was up 24.37% year over year, but EBITDA shot up 44.52%.
That differential is the key. They have phenomenal operating leverage.
Exactly. They are pushing so much more volume through their established dealer network that the top-line growth is dropping straight to the bottom line at an accelerated rate.
And you can see that confidence reflected at the ownership level, too.
Right. The promoter group, Sanjay Agarwal and family, maintain roughly a 65% shareholding and 0 shares are pledged.
That pure alignment tells you the founders don't need to leverage their equity to generate personal liquidity or fund outside ventures. They're fully tethered to the organic cash generation of Sirca.
So we have a debt-free balance sheet, roughly 20% EBITDA margins, strong operating leverage, and unpledged promoters. They're perfectly positioned.
They really are.
Which brings us to the mountain they're trying to climb. Management has publicly targeted 1,000 crore rupees in revenue by 2030.
It's a huge jump.
To give you context, their FY26 total income was 496.35 crore rupees. They basically have to double the size of the business in 4 years. How does a company constrained by a 200-day working capital cycle actually execute that?
The sources outline a very deliberate 3-lever execution strategy. It requires optimizing what they have, changing what they sell, and expanding where they sell it.
Let's break down lever 1. Squeezing the existing network. They currently have a network estimated between 2,500 to over 4,000 dealers.
The most efficient path to revenue growth isn't always acquiring the next new customer. It's maximizing the wallet share of the customers you already have.
Right.
Sirca's immediate objective is increasing the throughput in those existing stores. If a dealer in Punjab is currently only buying the premium Sirca PU, the sales team's job is to get them stocking the Unico mass market line and the Wembley enamels.
And importantly, they have the physical capacity to fulfill that throughput. Their existing 16,000-ton manufacturing plant is currently only operating at roughly 70% capacity utilization.
So there's plenty of room to grow without building a whole new factory yet.
Exactly. Management expects to hit 100% utilization at that specific plant by Q2 FY27.
Which ties perfectly back to that operating leverage. Absorbing overhead costs across a fully utilized, already paid-for facility is the fastest way to protect and expand those 20% EBITDA margins as they chase the 1,000 crore top line.
But they aren't just filling up old factories. Lever 2 is where the business model fundamentally shifts. Supply chain integration and product adjacencies.
This is a really big deal for them.
The big news here is that by Q4 FY26, Sirca is consolidating 3 separate Wembley manufacturing units into one single integrated facility.
This is a structural evolution. They're pivoting from being primarily an importer and blender to a true integrated chemical manufacturer.
That's a huge shift.
It is. They are investing in local resin and acrylic manufacturing. Furthermore, they are aggressively pushing into water-based or waterborne coatings.
Why does moving into water-based coatings and local resins matter so much for hitting that 1,000 crore number?
Because it allows them to sell comprehensive wood finishing systems entirely in-house. Rather than importing a top coat from Italy and buying local commodity thinners to bundle with it, they will manufacture the stains, the primers, the specialized thinners, and the resins themselves.
So they own the whole stack.
Yes. When an OEM builds a luxury modular kitchen, Sirca isn't just capturing the budget for the final glossy coat. They're capturing the entire chemical spend from the bare wood up to the surface.
It increases the ticket size per customer significantly while shielding them from the import vulnerabilities. Which brings us to lever 3, structural tailwinds and geography.
The macro factors.
We already discussed the macro tailwind, the formalization of the woodworking industry. As on-site carpenters are replaced by factory-built modular setups, the demand for standardized, sprayable PU naturally scales. But geographics are their Achilles heel right now. They are heavily concentrated in North India.
You cannot hit 1,000 crore as a purely regional player in India. The purchasing power in the South and West is too substantial to ignore.
The sources detail their targeted expansion into South and West India, but they can't just parachute a few salespeople into Bangalore and expect to win.
Exactly. To replicate their Delhi NCR dominance, they have to replicate the ecosystem.
Which means?
That means localizing capacity to ensure product availability doesn't suffer from cross-country shipping delays. More critically, they have to deploy those specialized technical applicator teams to the South and West.
The high-touch model again.
Yeah, they have to build new Sirca studios. The high-touch model has to scale geographically.
If they can copy-paste their North Indian playbook into the South and West while running fully utilized, locally integrated manufacturing plants, that 1,000 crore target actually looks incredibly realistic.
It's a compelling, high-conviction bull case, for sure.
But the market isn't blind. A lot of this operational excellence is already priced into their valuation multiples. It is our job to look at the cracks in the paint. What are the bear case scenarios? What breaks this compounding machine?
The risks are structural, and they sit heavily on the supply side and the competitive landscape.
Let's start with the raw materials, because this isn't a software company with zero marginal costs. This is heavy chemistry. What actually goes into these premium coatings?
Solvents are a highly significant input cost. In fact, solvents account for roughly 40% of Sirca's raw material expenses, and the price of those solvents is inextricably tethered to global crude oil prices.
So Sirca is basically holding a hidden derivative on oil. If geopolitical tensions cause crude to spike, Sirca's raw material costs immediately inflate
Yes, that's exactly right. And compounding that is the euro to INR exchange rate risk.
because of the imports.
Right. We noted they are pushing for local manufacturing, but a very substantial portion of their core highest margin identity, the flagship Italian PU, is still imported.
So if the currency swings,
If the Indian rupee depreciates against the euro, their purchasing power collapses. Their gross margins would instantly compress before they even have a chance to renegotiate pricing with their Indian dealers.
and trying to raise prices on those dealers brings up the second existential risk, the Goliath squeeze.
Yeah, Asian Paints, Burger, Narrowlack.
They're not going to gracefully concede the high-margin premium tier to Sirca.
The giants have a structural advantage in dealer relations. They can utilize aggressive trade discounts and highly lucrative volume schemes.
It's basic leverage. If an Asian Pays rep walks into a massive distributor and says, look, if you drop Sirca and push our premium PU instead,
Right.
we will give you a 5% back-end rebate on the 10,000 liters of standard wall paint you already buy from us.
Exactly.
That is a brutal financial proposition for a dealer to turn down.
That is the exact friction point. Sirca has to hope that the architect spec-in and the technical service superiority can counteract the brute financial force of the monopolies at the retail shelf.
And if it can't,
If they are forced to drastically increase their own dealer incentive spending just to maintain visibility, those pristine 20% EBITDA margins will erode pretty quickly.
there's also the macroeconomic reality, cyclical demand. Sirca's revenue is strictly tethered to the real estate cycle, urban housing formation, and discretionary interior fit-outs.
It is the definition of discretionary spending.
Right.
During an economic downturn, a homeowner might still buy a cheap bucket of paint to touch up a scuffed hallway. It's unavoidable maintenance. But they will absolutely delay commissioning a 15 lakh rupee custom Italian finish kitchen.
Makes sense. The premium wood coatings market is highly elastic to broader economic sentiment.
Very much so.
Finally, looking at the governance and corporate structure, I have a question about concentration risk. The sources note that compared to the top-tier mega-cap peers, Sirca's disclosure depth regarding related party transactions is somewhat limited. Are they overly dependent on a small web of promoter-linked relationships or specific regional distributors in the north?
Well, while the provided material doesn't flag any overt governance scandals, limited disclosure depth inherently requires a higher degree of investor trust.
Sure.
Given their heavy concentration in North India, their revenue is likely deeply tied to a handful of apex regional distributors. If a key distributor relationship sours, or if they defect to a Goliath offering better credit terms, the near-term impact on Sirca's top line would be disproportionately severe.
It's a lot to weigh, so let's synthesize the Sirca story for you. We are looking at a highly profitable premium challenger wielding Italian brand heritage in a deeply underpenetrated, unorganized Indian market.
Yeah, that sums it up well.
They boast roughly 20% EBITDA margins, phenomenal operating leverage, and a pristine, debt-free balance sheet. But the path to 1,000 crore rupees requires navigating a grueling 200-day working capital cycle, heavy vulnerability to crude oil and currency swings, and the relentless pressure of industry giants trying to buy out their dealer network.
If we pull back from the balance sheet for a second, this raises an important question, a broader philosophical shift in the market.
Ooh.
What's that? Sirca's entire identity is currently anchored to that Italian license. But they are aggressively integrating their supply chain, synthesizing their own resins locally, and building massive domestic plants.
Right, we just talked about that.
So as India's domestic manufacturing capabilities continue to mature across all chemical sectors, and as local quality unequivocally matches global standards, will the premium Indian consumer's psychological bias toward European origin eventually fade?
That is a fascinating angle. Does the prestige of the Italian flag on the motif day can outlast the reality that the chemistry inside is increasingly being engineered in local Indian facilities? Or is heritage branding truly the ultimate unbreakable moat in the luxury tier, regardless of where the molecules are actually mixed.
It's something to think about.
That's something to mull over the next time you run your hand across a perfectly smooth high-gloss table. Thank you for joining us on this deep dive into the sources. Keep exploring the hidden niches of the market because sometimes the most incredible compounding stories are quietly coating the cabinets right in front of you.